thanks for tuning in for another episode of Ask Spurrell CPA. Today we're talking about corporate tax payable and expense. So the difference between corporate tax payable and expense. I got May here with me again. So May, do business owners like paying taxes?
No. No.
So helping them understand what amounts they have to pay, can be a little beneficial. The quote that we have for you today, Jim Collins, author of 6 business books, including Good to Great. That's one of my favorites. Is thoughtless reliance on technology is a liability. Thoughtless reliance on technology is a liability. The Fraser Institute, calculates that the average Canadian pays 43% of their income in tax. CPP, EI, GST, fuel tax, etc. By comparison, we're only spending 37% of our income on shelter, food, clothing, basic necessities. So, tax is going to be the biggest expense of our life. Whether we realize it or not, it's probably going to dwarf the cost of our homes and our cars several times over. And the story that we have are, the financial statements that business owners make their decisions on have significant errors, and a lot of those errors have to do with their tax accounts, and often it's due because the accounting software is automatically posting one or another tax balance to a particular account, and the business owner is just completely relying on it without truly understanding what these tax accounts mean. So, May, what are the questions that these business owners should be asking?
Well, the first one is, what is the difference between tax payable accounts and tax expense accounts?
So a tax payable account is something that you use to make an installment or books the balance owing. So you have a balance owing. Your tax at year end was calculated as I owe $10,000 in corporate tax. It's then added to a tax payable account on your balance sheet, and as you pay that balance down, it starts to decrease. Okay, so the tax expense account happens a year end, and then what happens is as you pay it, that balance is added to the accounts payable, and as you pay it, that balance decreases until it's zero.
In Alberta, why should you have a federal tax and a provincial tax payable account?
So separatism is alive and well in Alberta, and a lot of people are very shocked by this when they start a business, that there is separate tax departments for CRA and Alberta Finance, and you actually write 2 separate checks that go to 2 separate buildings on your corporate tax. In a lot of other provinces, that you send it to CRA, and the CRA disperses it to the province, and that's in Alberta. That's how it happens for your personal taxes too. But your corporate taxes, nope, we have our own separate standalone tax department, and it's usually the first time Albertans hear of it or when they incorporate it and they have to make a payment to Alberta Finance for their provincial corporate tax amounts.
Why are tax payments generally posted to a payable account and not the expense account?
Yeah, so when you're paying it, that's not when the expense occurred. The payment goes to a payable account. It's just like paying on a bill or on a mortgage. That's not the expense. We're just making a payment, and it goes right to the payable account. So the $10,000 was booked when the expense occurred, and then as you pay it $2,000 at a time, it's going to knock down that payable amount. So the payment doesn't necessarily mean the expense. Plus, there's always installments to be made too. So we should be prepaying tax. It's not just doing 5 installments and knock down that $10,000 balance. Once we're done with that $10,000 balance, we should be making installments for next year. But those installments don't relate to the actual expense account. They're just prepayments on the anticipated amount, so we can forego any interest.
Do payments to the payable accounts get reflected on the profit and loss statement?
They don't, yeah. So the payments don't get reflected on the profit and loss statements, and that's a good thing, because we want to match this to the period that it occurred. So we don't want to have in 1 month a tax expense to occur, and then all of a sudden all of these payments to the tax expense accounts, the one lump sum payment that occurs in the next month to make your income statement look like you didn't make any money. That's not how it occurred. So that payment goes to a tax payable account.
At what point in the year do you actually calculate and post the tax expense?
So it's usually at year end. You're going to calculate this tax expense. Bigger companies, they might be making a tax provision each and every month. But that's complete overkill for a small business. So a small business is only going to actually know what that tax bill is, what the tax it's going to be calculated at the end of the year when they do their corporate tax return. So that's when that tax entry is going to occur, normally on the year-end date. And the entry is basically going to book an expense, and it's going to book an offsetting payable. So the tax expense was $10,000. It gets put in there only at year-end, and then the payable, also shows up as $10,000. And then slowly we're going to knock those payments over time. So we're looking at the average business owner. You shouldn't ever be posting anything to your tax expense account, because you're not the one that does the corporate tax return, and they don't know what the tax bill is, but yet they know very well what payments they're making every month, and those payments should be going to a tax payable account. And in Alberta, it's going to be a federal tax payable account and a provincial tax payable account. Most other provinces, that's not the case. It's just going to be one federal tax payable account, but the payments are separate.
So should CRA GST payments be posted to a separate account?
Yes, a separate account all the time. And this is a very, very common error, where we're going to have a corporate tax payable account, and we've got a corporate tax expense account, and we have a GST payable account, and all of the payments are going indiscriminately to one account or the other, and often they just create the check, and CRA remembers whatever, the bookkeeping software remembers which account you posted to last time, which might have nothing to do with this time. So remember, the tax expense account is, it should be put in there once a year when the accountant does the corporate tax return, and it doesn't deal with an actual payment. It just deals with the taxes calculated at your corporate year end when the tax return is done. And then the payments to the corporate tax account go to federal corporate tax payable, maybe provincial corporate tax payable if you're in Alberta. And then the GST payable is a separate account, right? Now we're dealing with 4 accounts, tax expense, federal corporate tax payable, provincial corporate tax payable, GST payable, and we've got to make sure that we're not commingling these payments from one account to the other.
Do CRA payroll payments get posted to a separate account?
We got another one. Now we got number 5. So we have these accounts here. We have a tax expense account, and we have the payments to the payroll account. They're different, okay? So the payroll account should have its own, payroll tax payable account or payroll remittances payable account, and that's always being offset with wages. So those tax expense, they're not a tax expense, they're a wage expense when we're talking about payroll remittances and source deductions on payroll. So there's 2 components to the payroll. There's the payroll components that you deduct off of the employees' checks that you got to send in. Once you deduct them, they go in your payroll tax payable, and then once you send them in, you eliminate that payable balance. And then there's the amounts that you have to pay the employer contributions of CPP and EI. So if we deduct $1 off of the employee's check for CPP, the employer has to kick in another $1 and send $2 to CRA. And EI, it's $1.40 for every $1 you take off. So those are separate accounts. So we got to make sure we understand what they are. So we have a corporate tax expense account. This is on your profit and loss statement, and that's the only time anything's going to get entered into that is at the corporate year end when the accountant actually calculates the corporate tax expense. Then we have the federal corporate tax payable account. Every time you make an installment towards federal corporate tax payable, it goes there. We have the provincial corporate tax payable account. Every time we make an installment to the provincial corporate tax payable, it goes there. Then we're going to have GST payable. Every time we make a payment for GST, it goes there. And then we have a payroll withholding account, and every time you make a source deduction payment to CRA, it's going to go there. And it's important to understand those different accounts, and we're posting them to the correct account, because it's extremely common for business owners to cross-post these to different accounts, and the balances are ultimately just meaningless because you have GST and payroll and corporate tax, and if you want to know how much you owe at any given time, you have no idea.
And should you ever see tax, payroll, or GST amounts in accounts payable?
Yeah, absolutely not. We should not move and sometimes accounting software will automatically move the GST bill in there if you don't, select cancel and select that you don't want that. So yeah, same with I've seen it on source deductions, withholding tax, it's going to add it to the accounts payable. it doesn't belong there. It already has its own account. We want the convenience of having that one balance. We have to create this account because it's a balance that has to be reported at year end. Why are we going to commingle it with accounts payable? It doesn't make any sense. At any given time, we want to know, okay, where am I in terms of my corporate tax payable? Have I paid off my balance from last year? Have I started, created payments for next year? At this point, we have separate accounts for them, so they should never get mixed in with accounts payable.
And why should profits generally be higher than the corporate tax installment?
So we have to remember that we're not calculating the corporate tax expense on a monthly basis. You're looking at your monthly reports. It's impractical to calculate that on a monthly basis for most business owners. For most small business owners, it's too cumbersome. So what we need to think about are what are the installments we need to make. So we got to make an installment of $1,000 a month to corporate tax payable. Well, we better be making at least $1,000 a month from the business. And normally it's, we're also thinking about the draws that are being made as well. So we're generally looking at, the business makes, say the business makes $6,000 and the owner takes $4,000 a month and the loan payment is $1,000 and the tax installment is $1,000, we're okay. But if the business only makes $5,000 and we don't have enough to cover the draws and the loan payments and the tax installments, we're going to start bleeding cash. We're going to start going through our cash very quickly. So we got to make sure that our profits are higher than that intended tax installment.
And why do profits not have to exceed the CRA payroll and GST remittances?
So those are different because let's remember that the corporate tax, that's paid out of profit, that's paid out of net income. But the CRA payroll tax, those remittances, they're already in your employment expense. So we don't need to be able to deduct them again. So whatever we put to that CRA payable account, it's already in the employment expense account on your income statement. So we don't have to worry that the business needs to make at least that again. Same with GST. GST just completely bypasses the income statement altogether, and every time you collect GST, it just increases your GST payable, and every time you pay GST out, it just decreases your GST payable. So it's not the same in terms of do I need enough income to cover my CRA payroll and GST remittances. Because we'd always be double counting them. Corporate tax is the one. We got to make sure that those profits on the income, profit and loss statement are at least as high as the required corporate tax installments because they have to be covered from profits. So that's what we have here again. Thanks so much again for tuning in. As always, please hit that like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions, please leave them in the comments below. We'll do our best to address them quickly in a future video. Thanks very much.